let's just start zeroing on the first rates right now. In the first rates, any second, I'll let the wall do all the talking. 1450 advances, 195 stocks which are declining. It's almost like a near perfect market breadth what we have. I mean, one day of a comeback in Reliance and the market get convinced that the leadership in the market which was missing seems to be making a comeback. You want to look at Bajaj Finance, Reliance and Jio. Why am I saying Jio? Because I mean, let's be clear, it's a stock where right now the positioning is strong but the earnings are not there. But will there be a rub-off effect of Reliance onto Jio Financials? Let's see if that happens. PFC, REC, these are two stocks which in a sense could be really called as the Wonder Boys because they've just defied all laws of gravity. Defense and railways ahead of budget. No large change in allocation is expected. I mean, if at all, if the expenditure side of the government remains strong, then the road companies and the construction companies, some of them may remain charged up. But it's a neat start. It's a decent start. And for Bajaj Finance also, just when everyone thought that, okay, the reaction is going to be really harsh, I think it's not there. I mean, 5%. Financials are just getting clobbered in terms of what the post-number analysis is. It happened with HDFC, happened with AU, and now Bajaj Finance.
Oh yeah, quite a bit of sharp reaction. A 4% fall, no less, coming in on Bajaj Finance. Not just it's breached that 7,000 rupee per share mark, but it's sub even 6,900. ITC is the other one. A bit of a weak quarter number from them in the third quarter. The cigarette volumes have clearly declined. That being the cash cow business for ITC, 443 is where that stock is right now, and that's also seeing a dip. Marico too, by the way, the consolidated revenue from operations has come down. It's seen a bit of a slip, although the stock is not seeing a slip for sure. That's still holding up in the green. And then, of course, some dhamaka earnings like a NAM, Restaurant Brands, Venus Pipes. You know, we forget tracking large caps as to how large the pool of small and mid caps is, and that's where the earnings growth is coming in. A reason why the small cap index perhaps is still close to its all-time peak. NTPC also, by the way, came out with its numbers, and so did Piramal Enterprises, Vodafone Idea 2, RR Cable, the relatively newer listing from a very fancied sector. All these, even though the earnings have been a bit disappointing, you're not seeing any red on the ticker right now. Petronet LNG also came out with its numbers. The EBITDA has seen a jump up of 40%. Margins as well have expanded on a sequential basis to 11.6% versus a comparable of 9.7% on a sequential basis. So look out for that stock as well. Order inflow continues for the likes of KEC International, Muthoot Micro, Nuvoco, Krishna Diagnostics, Restaurant Brands like I earlier pointed out, Aditya Birla Sun Life. The profits have surged almost 26% over there. And then Godfrey Phillips as well, which has seen the revenues rise near about 36%. So all these stocks are in focus and they will just come up for you on your screens. For the index though, largely because of I think what Bajaj Finance is doing, and I want to revisit what RIL as well is up to after that big tear on the stock. Where is that stock settled in at? RIL will just come up for you on your screens next. But Naresh, what's the strategy for the day? Any trades that you're punching in?
So continue to like Concor as a bet in the PSU space, which can take leadership from here. So Container Corp is a buy at current levels.
All right, let's connect with Mihir Vora now. Let's talk markets, budget, and how things are looking up in terms of the market mood. Mihir, good morning. Thank you for joining us. Are there any expectations from budget this time?
I think the budget, being an interim budget, should not have major shocks. But it will be interesting to see how they balance the imperative to trim the fiscal deficit to as close to 4.5%, which is the glide path that we have to show, especially given the fact that this is going to be the year in which Indian bonds get introduced to the global bond indices.
She will still have to give a number for FY24.
Yeah, absolutely. So my guess is about 50 basis points reduction in the fiscal deficit will be shown.
So 5.2.
It should go from 5.8, 5.9 to about 5.4, 5.5.
5.3, 5.4 is the general view.
That's the number they should show. Revenue expenditure may not again grow that much, but given the fact that this is an election year, it's going to be a fine balancing line, because for the last couple of years they have not grown revenue. They have kept subsidies under control, but there is rural stress that we can see. On the other hand, capex has been doing very well, and we all enjoying the benefits of the big spending capex. that probably may be curtailed. Let's see how the
But the
balance
tax
pans out.
collections have been very buoyant.
Exactly, yes. And that's the reason why they've been able to spend on capex.
But she will have to spell out, or the finance minister will have to spell out few basic assumptions.
Yes,
Which is your assumption for fiscal deficit for FY25.
yes.
She will have to give an indication of what the expenditure plan would be, capital expenditure, and what is her assumption for direct and indirect tax collection or revenue collection for FY25.
Absolutely.
Those are important numbers.
Absolutely. And my guess is they'll work with a nominal GDP growth rate about 11-12%.
Okay.
Right? And while direct tax collections have been very healthy this year, indirect tax collections are not that great. So it is basically direct tax collections which have been buoyant. FY25 may not see as much growth in direct tax collection because we are working from a high base. Indirect tax collection should improve. So there again the composition may change. But my guess is it will be 10% growth in most of the expenditure items and the revenue tax collection.
And that is good for market?
That should be good enough for market. I don't think we are expecting too much, frankly.
Okay. But would it have a populist tone? Will the government try and bump up the rural end of the economy, which has been beleaguered?
Yes, absolutely. That's what I was saying. No? They haven't been spending so much on revenue and subsidies in the last couple of years. But this is an election year. So we might see some, for example, the PM Kisan, that's an important scheme. The Pradhan Mantri Awas Yojana may be rolled out for rural people, rural poor also. So those kind of, schemes. It may not be, huge amounts, but directionally and at least from the tone and tenor, you might get to hear some expectations. I think they might do something more on water because that's again a critical focus area. So those, I think, social schemes may be expanded this year.
And do you think revival of consumption is going to be a key theme since you're talking about things like rural?
Yes, absolutely. Especially as I said, it's an election year.
Yeah.
So they would want to have some feel good there.
So Mihir, if there would be an indication on assumptions, which is direct taxes, indirect taxes, fiscal deficit, capital expenditure, subsidy spend, then it's almost like a full budget. And what else normally comes in a full budget?
Yes,
These are the 4-5 data points.
You may not have major tweaks in the tax structures or, people expecting something on capital gains and stuff like that. That they might leave it for August.
I don't know.
I'm always wishing. I'm always wishing for a reduction in percent taxes.
So, really? I mean, somebody's expecting it. Who is this person? How to meet man?
Yeah. So nothing big bang, I guess, in terms of tweaking of taxes.
So what that means for the market? I'm just trying to understand that, okay, it turns out to be a budget which could be called as a no-harm budget. Everything remains in terms of status quo. What markets are expecting, they get everything. The market has not seen a wild pre-budget rally or a pre-budget sell-off because of any concerns.
Absolutely.
So 1st of Feb, budget gets over. The 2nd of Feb, will it be back to square one?
I think it is. And I think it's a sign of a maturing and matured economy that budget is not a big deal anymore. Look, GST, which is a big component of tax collections, is anyway outside the budget, right? The GST Council decides that. And corporate taxes, direct, and all the other, personal taxes, slabs have been rationalized, and government anyway wants everybody to move to the new regime, which is far more simpler. So there is not much tweaking left in any case. It's not like the old times where you had to wait for import duties on specific items to be changed, and all that gaming of
Mehanga
the system.
Sasta, remember the graphic?
Yeah. So all those
every sector researcher was an adrenaline. But
shoes are expensive, but shoelaces are cheaper.
Yeah, exactly. So excise duty tweaking and all those things are gone. Yeah.
Cigarettes are expensive, but bidis are cheaper. Those days are gone.
Yeah.
And whatever millimeter, something. But I think, more than the budget now, the positioning of the market is towards the elections. And I think the proof is in the reaction that we had post the state elections.
The markets seem to have given the verdict on the elections. Right?
And why not? Because look at what's happening in, say, for instance, with Nitish Kumar over the weekend. It's only making your case stronger that it's going to be a very fragmented opposition.
Absolutely. So markets are already discounting, I think, continuity of the regime. And so I think it's back to global economics and our own initiatives on various fronts that we are looking at,
And let's also talk about the positioning of the foreign institutional investors in terms of what the expectation is for the year ahead, election year, budget, etc. Do we think we can lean on support from the FIIs? A small buy figure just yesterday.
I think so because, there is, as of now, I mean, there was a risk off environment, say, a month ago, but now it's back to risk on globally too. And India is expecting bond fund flows also, so currency hopefully will remain stable. So if you got good tax, good interest rates and a stable currency, then FIIs should come both in equity and fixed income, my guess is. I mean, anecdotally, as you know, I'm building a team and I can sense that there are lots of FIIs looking to hire analysts and fund managers because I am hiring, so I know who I'm competing with. So there are funds who are coming to set up India desks with 2 or 3 people. So there is definite interest in India, especially given that now we are looking for a India specific fund regime. Earlier, it used to be global funds or GEM funds, global emerging market funds who used to invest in India. But now I think it's coming back to India-specific funds also. And I can see that, interest in India for the long term.
But that interest is definitely not coming back to the financials. And I mean, rightly so. The earnings are, proof at that. Be it an HDFC Bank or Bajaj Finance yesterday, wherein the asset quality is marginally deteriorated, the pressure coming in from personal loan slippages.
I think it's a bit of a cyclical issue, and we've seen time and again. Banks and NBFCs are the smartest people. They will maintain their margins ultimately. So if not this quarter, next quarter. If not, then quarter after next. So I structurally don't see a squeeze in margins. It's just that the RBI has kept liquidity tighter than what was expected. So to that extent, I think it's more a function of the tactical stance that the bank has taken, the central bank has taken, which is kind of impacting margins. Otherwise, I don't see a structural issue, frankly. If we are talking about 7% GDP growth for FY25, then credit growth has to be 15%, and of course the smaller banks, private sector banks and NBFCs will grow faster. So I don't think that thesis has changed, frankly, except for some pockets, as the RBI has rightly mentioned, in retail loans or unsecured loans, there might be some stress. But as a part of the overall system, it's nothing to worry about.
So long-term money, you're saying, should find a value at these levels after the correction that's played out in
These
private
are some
banks?
of the Indian private sector financials are some of the best managed financials in the world, whether it's in terms of technology or branding or product mix. I think they're pretty much there.
Mihir, but for markets to, let's say, significantly go higher, I'm not talking about like what happened yesterday. That was more like a technical adjustment. Let's say 10% or 15% higher. What could be that trigger? Election verdict already in the price. Budget is almost like a no event. Globally, inflation peak is behind us. So what could really, push markets higher by even 10% from here?
It's, I think, sheer earnings growth. We're expecting 15% earnings growth for FY25. That alone should take the market to, to at least high single digit. And if the consensus say veers towards GDP growth of say 7+, then probably we can see some more upside if there are upgrades. Otherwise, there are so many sectors which have still not even reached their pre-COVID levels. For example, auto is now reviving, but if you look at the auto unit numbers, they are still only a little above pre-COVID levels. So we really haven't done in a lot of sectors that much. So there is a lot of consumption catch-up to be done, frankly, I would say. Real estate again has started performing now, but there was a long period of underperformance and lack of volume growth. So there's a lot of sectors where we still have steam left.
Yeah. No, I'm just putting the question in reverse. Okay, fair point. Sectors which have not reached pre-COVID, they still have headroom left. Autos, even pharma. But there are a lot of sectors which are way above pre-COVID. PSUs, railways, defense. What happens there now?
See, again, we have to look for IT also. You can say IT also this big. But in each of these, we'll have to look at it sector by sector. IT, for example, I would be a bit cautious. Because relatively speaking, I think the domestics should do better, and as we said, IT is far above the pre-COVID levels, and probably the best of the growth that we've seen in FY22-23 is not going to be seen at least for a few years. So IT, I would be a bit cautious, but in terms of defense, railway, etc., these are paradigms which have emerged only in the last 2 years, and it's in a sector which is newly emerging, I would say, and I would say newly because these companies were always there, but the policy has changed. So when you're talking about policy change, you don't even know what the total addressable market is, whether it's only domestic market for replacement and Atmanirbharta, or we are talking about global exports. If you're talking about global exports in this segment, then the TAM can be the total addressable market can be much wider. So right now the stocks are probably running a bit ahead without visibility, but that typically happens in high growth segments.
And what about, given that there's so much optimism about generative AI, etc., and you're looking at online B2C, you're saying that's an important sector?
B2C, I think, again, broad thesis, if you see, is that intangibles, branding and technology will form a larger and larger part of the market cap. In the US, 40 years ago, 80% of the market cap or EV of the stock market used to come from physical, tangible assets. Now it's the other way around. intangibles is now 80% of the EV. Similarly, in India, if you look at even the Nifty, for example, financials, IT, pharma, FMCG, this will all be 60+% of the market, right? These are asset-light models. So I think intangibles, network effects, AI, those kind of things will continue to have a bigger and bigger impact on the market, and these are segments which are here to stay. There might be winner takes all kind of a situation where in each of the segments there'll be only one or two players, but that's the way it's going to be.
Yeah. You think energy is the space to be in right now? You're already seeing some of the stock prices reflect that. What with the move on in ONGC, Reliance, etc. Though Reliance is not a pure play energy business at all. But you think that's a space that you need to have as part of your core portfolio? And I would include power as well over here.
Power I would treat separately,
Sure.
but energy I don't like the sector, frankly speaking. I mean, it might look cheap and we might play tactically from time to time, so don't hold me if it's there in the portfolio. But it's not a structural bet, it's a cyclical bet. Sometimes the valuation catch-up game, sometimes it's probably a small momentum play on oil prices. But problem is that it is a heavily regulated sector and margins will be controlled if they go out of whack. So ultimately, you can't give very high valuations to segments where there's good guarantee of government interference from time to time. So I would not value them very, very highly. Power probably is a different segment where we are really facing a shortage, and these are good manufacturing kind of companies. There the growth rate and the path to growth may be a bit longer.
Okay, Mihir, great to have you on the show. In fact, you've given us a lot of food for thought for our next expert. We've got Prabal Sen joining in right now on the show from ICICI Securities. Prabal, I don't know if you caught Mihir Vora, our previous speaker, and his thoughts on the energy sector, especially in light of the parabolic move on ONGC and Reliance just yesterday. What is your own thought on whether these are just tactical plays, or do you think they should be part of your long-term portfolio?
I think I would not even try to comment on Mihir sir's comments. Not my place to sort of contradict him in any way. Having said that, I do believe that if you look at the oil and gas sector, typically the periods in which Indian oil and gas sector does well is when crude prices and gas prices are in a certain range. And whether by chance or circumstance, what has happened is that if you look at the crude price range today and the likelihood of where it's going to be over the next 9 to 12 months, the prices are likely to be in the $75 to $85 range, which tends to be, at least in the current environment, a pretty sweet spot for one, margins to continue to stay stable or high, specifically on the marketing front, and also GRMs to also continue to be in a range of $9 to $11, which we believe is a very strong level for earnings growth to continue, at least for refiners in the country. Similarly, gas, we are seeing that the kind of weather patterns that have been there in Europe for the last 2 years, the kind of inventory buildup they've had, and the prospects of LNG supply, despite the current US decision to put on pause new projects, the existing plans itself ensure that supplies are going to be adequate for global LNG requirements over at least the next 2 to 3 years. So, from that aspect, given that as a country we continue to be price takers for both oil and gas, the easing of prices in a certain range is essentially very positive. Specifically for ONGC and Reliance, I think earnings growth is something that's going to continue to be very strong. Reliance, very clearly, with the multiple levers of growth from retail, from the improvement that is expected by our telecom team in Geo in terms of tariffs as well as subscriptions, and the momentum that they continue to show in the retail business, we believe that EPS can continue to grow for a company even on this very high base at about 15% CAGR over the next 3 years, which is FY24 to 26. And similarly, for ONGC, after a 7-8 year lag, now that production growth is becoming a reality, at least from a 2 to 3 year perspective, thanks to the startup of the KG Basin asset, it reverses actually pretty much a last 7-8 year old trajectory of sort of muted production and realizations, despite windfall taxes at the levels of 75 odd dollars for oil and $6.50 in MMBTU for gas, will continue to be at a 7-8 year high. So both those stocks, I think, from a growth perspective, are expected to remain fairly strong.
To Reliance, is it right to only look at their O2C business? Because that's almost, that's like 25-30% of the business. On sum of part, it's retail, it is geo, it is the new energy business. What's the right way of looking at Reliance now?
I wish I knew the answer to that. I think the issue is that, and I never, the earnings growth that we spoke about of 15%, ironically, is not really coming from the OTC business. The OTC business, we believe, despite the fact that I spoke about refining being in a good spot, petrochemicals, which is an equally important part of within their OTC segment, is not likely to actually grow by any significant way, because there's a lot of oversupply that exists in the system. So if I break it down in terms of where earnings growth is coming from, it's more from the telecom business, it's more from the retail momentum, and some portion, low single digit growth is what we build in from the OTC business. The way to look at it right now is, if you look at what will be the drivers for the stock or the business for the next 3 years, one, very clearly, new energy. Whatever milestones that we keep hearing in terms of hitting the commissioning of the first few units, any commercialization of new technologies like sodium based batteries, which they're trying with their Faradion acquisition on the battery front, and of course, in terms of, what kind of numbers start to actually come from the new energy business as and when it commissions. The third aspect that I would also look at is that there is a significant amount of capital allocation that has happened in the business in the last 3 to 5 years, and there is expected to be more capital allocation on new energy and continued capex on retail as well as geo. Now, what happens to the FCF fields, what happens to the return ratios, those I believe are also probably slightly overlooked factors in the kind of strength that the stock is showing right now. And that is something that makes us a bit more cautious at these levels of, predicting outperformance, at least in Reliance over the next 12 to 18 months.
Importance would you pay to their capex cycle? Because historically we've seen in last 20 years, Reliance 2 years ahead of the capex cycle starts moving, and 2 years after a new capex cycle is announced, it starts underperforming. That 2 year window gets over now.
Yeah, exactly. So what has happened is, you're absolutely right. In the last 10 years, there have been multiple instances where the stock has outperformed quite significantly on the expectation that the capex cycle is now over. We're going to start to see massive FCF conversion happening, and therefore, leverage going to continue to go down, and a huge expansion in return ratios. And that, I think, has been held up because there has always been the next big thing that Reliance has been basically betting on. Firstly, it was the petrochemical expansion, then it was telecoms, now it's probably new energy. So we're going to have to see whether, the capex cycle ever comes down below that typical, I think, the sweet spot of around, 80 to 85,000 crores, which enables a much more positive, delta in return ratios and FCF yields. As long as capex remains, in the range of 1.2, 1.3 trillion rupees, which they have been doing and are likely to end this year also with that level, I think that transition to high double-digit return ratios doesn't really happen. Now, it's another matter what investors are looking to put value on, whether the bet on new energy is significant enough that they, this portion is this part of the valuation story is overlooked, and that's something that I think the markets will basically decide over the next 2 years.
Probably going down the line, what do you think are going to be some of the key catalysts ahead for investors when it comes to Reliance Industries? Will it be retail and telecom as the key drivers?
I think any sign of actual tariff improvement in telecom will probably be keenly watched. Retail, I think, the growth has been fairly in line, and has been meeting or beating expectations. So obviously that continues to be a monitorable. I think news around the new energy businesses, as and when the first of the units gets commissioned, and what sort of results actually come through, how soon it sort of starts to actually reflect in the EBITDA numbers, which I guess today is likely that FY26 will already start to show some of those numbers. And how do the initial results look like, whether it's the battery facility or the solar manufacturing unit, which are the two perhaps earliest ventures that are likely to get commissioned. I think those will probably be the keenly focused triggers.
Thanks so much, Prabal, for sharing with us your thoughts on Reliance Industries and what really is the outlook for the overall space as a whole. In fact, staying with that, let's talk about Mahanagar Gas then and understand what the triggers have been for their volume growth and what the outlook is when it comes to their margins. Ashu, Shingal is the managing director and now joins in on the show. Thank you so much, Ashu, for taking time out. To begin with, let's discuss the volume side growth. It's been a 3% sequential growth. Is this looking sustainable into the coming quarters?
Yeah, good morning, everybody. Yeah, it seems to be picking up. Last quarter or quarter on quarter, it is 3.5%. And if you compare to the last quarter of the last financial year, it is more than 7% growth. So going with the trend and initiatives which we have taken, the prices, and we expect that the volumes will grow slightly further or stabilize in future.
Okay, and what about your margins? Because they've been impacted on a sequential basis largely on the lower APM gas collection, the higher spot prices. Have margins recouped now with the spot gas prices falling?
Yeah, I think the margins are much comfortable. I mean, last year, financial year, it was 9.5 rupees EBITDA per SCM. Last quarter, we have clocked around 15.5, and now it is around 13.3 rupees per EBITDA per SCM. The point is that spot, we have now switched from spot gas to more term contracts. So that has given us more stability in the price and procurement cost.
Ashu, the other thing I wanted to understand was about the car conversion rate in third quarter. Tell us how that's been, and have we surpassed the previous quarter number, which was around 19,900? And if yes, what's led to the uptick, you think?
Yeah, I think we have bettered the last quarter's number. It is around 22,500 or around 23,000 new conversions have taken place in the last quarter. And till date, in this 9 months, we have around 57,000 have been converted, which was last financial year, it was around 65,000. So we expect that by the year end, we will touch around 80,000 conversions. So that's a good growth numbers. And we expect that next year also it will be continuing the same rhythm.
Right. And how's the overall CNG market looking like? Any early threats from EVs? Also, has there been an increase in MSRTC buses?
Yeah, first coming to MSRT buses, they are increasing the numbers quite substantially in last few months. Around 600 buses are plying on the road, 500 to 600. And they have a target to reach up to 1,000 buses in maybe another 5-6 months' time. So that is an upside on terms of MSRTC. Regarding CNG volumes, yeah, they are also picking up. And we have clocked a growth of around 7% year on year for 9 months. And we think that this will be continuing since the number of stations are increasing. The prices of CNG are also low as compared to the last year. So we expect that the volume of CNG will also be stabilized or further pick up in next few quarters.
Okay. It looks like a small trend right now, EV, but I'm again going with that as a concept, which is that increasingly EV will increase. So you are actually staring at a new source of energy which will grow. It may look small today, it may look okay tomorrow, but it could become very large in 5-10 years. How are you preparing for that?
See, we have to look at it in a more holistic manner. All fuels have a place in the transport segment, like coal is also there in terms of producing electricity, which is being used in running the EVs also as of now. But more and more greener electricity will come. But there are certain fuels which cannot be substituted, like diesel is one which cannot be substituted by EV in terms of heavy vehicle transportation. So as more and more highways are getting connected, more CNG and LNG applications will grow. So yes, you are right. Small segment, maybe two-wheelers and three-wheelers will be the segment which will be first impacted by the EV and more EV coming forward. But we feel that there will be place for a fuel like CNG and LNG, which is cleaner than petrol and diesel, to stay for a much longer period.
Understand your business. Can I say that it is a simple cost plus model? That's how things are stacked up for Mahanagar Gas?
If you say cost plus model, it is not entirely true because if we divide our business into 3 segments, one is that CNG is competing with petrol and diesel, and others are industrial commercial is competing with LDO, fuel oil, and other such fuels. And PNG is sometimes competing with LPG. So it's not exactly cost plus model, but it is a strategy of pricing to the competitive, it being competitive as compared to the alternate fuel.
So in terms of ensuring that your future source of supply is maintained, how are you doing it?
If we talk about supply, there are 2 points. One is that APM gas is being given for PNG and CNG segment, and HPHT is also allocated for the PNG CNG priority segment, which is around $10 per MMBTU, and APM is around $6.5 per MMBTU. So 100% of PNG CNG quantity is met through these two allocations. The rest is industry and commercial, which is through the term contracts of LNG. So the supply is not an issue. The point is that at what price we purchase the gas. So as of now, LNG prices are also reasonably normal. They are not very high. So we have term contracts related to Henry Hub and other such indexes, which give us the supply security.
Okay, and even post your recent acquisition, I understand that the company will be left with a decent amount of cash on the books. Can you tell us whether or not there are any other acquisitions in the works, or what you plan to do in terms of the utilization of that?
Currently, we are exploring few options, but none of them is yet frozen. The first thing on our mind is to stabilize our first acquisition of Unison and Enviro, which is expected to be completed very soon. The shares will be transferred. The lock-in period of 5 years is already over, which regulator has also given their green signal. So that will be the first thing. We like to consolidate that company into our fold. The other thing which we have done is LNG joint venture we have opened up. So new stations will be rolled out. At the same time, we are exploring and scouting for some opportunities as and when they come out. But it takes time for any acquisition to take place. Even this Unison acquisition has taken us more than 1.5 years to fructify, and finally the company is in our fold. So we are looking for the opportunity. As and when they come, we will be announcing it.
Okay. One advantage you have is that you have a monopoly, almost like a monopoly in the areas you are present. Is that a risk? Right now it's a blessing, but it could also be a risk as the economies open up, as if one looks at how competition is intensifying from the private players.
When you say monopoly, it is not entirely true, because the licenses are bidded through by the regulator and they are taken by individual company. That is the first step. And as I told a bit earlier also, that all our sectors like industry and commerce is competing with fuels. Then CNG is competing with petrol and diesel, and PNG is competing, that is the domestic PNG is competing with LPG. So it is not entirely monopoly, and there is also a talk about exclusivity, that after a certain period, the regulator opens up for certain percentage of the infrastructure to be utilized by other companies. So that also can be done. The matter is current sub judice. So as and when it happens, a part of it can be given to the other players. So I don't think there's a monopoly as such in the companies in which CGD play. It is just a matter of the way government has thought the licensing should be done, or the sector should be promoted to develop the infrastructure.
Appreciate your time. Thanks so much for joining in and giving us a better viewpoint on Mahanagar Gas. Watch out for when it comes to the budget, and we've got a star-studded lineup as well for you on ET Now. But ahead of that, how are the markets shaping up? And yes, while we're holding out in the green for the broader end of the market, you're not quite seeing that sort of fervor when it comes to the pre-budget excitement. Names like Bajaj Finance today, Bajaj Finserv are a bit under pressure. ITC is clearly reeling. Post its numbers, 445 on that stock, and ICICI Bank, HDFC Bank too continue to languish in the red. In terms of what's really propelling the markets higher, Tata Motors, Tata Steel, and you've got BPCL as well at the top of the heap. But considering, Nikunj, that it's literally a couple of days to the budget, you're clearly, I don't know if we can use that word, but not really feeling that excitement, are we?
See, Aman, over the years, you have to also realize that budget is now getting more and more predictable, and less in terms of having the nuances, nuances. What has been the broader messaging? The broader messaging in last few budgets has been that there would be stability, there would be impact, there would be allocation, which in a sense would be dominated by economics, not politics. Given that there are restrictions that this is vote on account, so no indirect changes would have assumed. What is always a big debate before budget? LTCG, long-term taxable gains. That is not under the preview of this government or this time's vote of account. Second, in terms of the basic assumptions for FY25 fiscal deficit, your total expenditure, capital expenditure, and also your revenue assumptions, I think they will be documented. And that's where I think the yes and the no actually would happen. A lot of assumptions which have happened by the government in the past, they've been very, very appropriate. They've been very conservative. In fact, if you read the assumptions for FY25 for direct tax collections, independent assumptions, versus if you see it what government assumptions are, the government assumptions are far more conservative than what the brokerage assumptions are. So I don't think from a budget standpoint there's anything to really worry about. And this I think is going to be like the proper budget where the tone would be set up in order for the next election cycle in terms of the Amrit Kal budget. We are calling it Vikas Ka budget, and I truly feel that this is Vikas Ka budget. Rajesh Sharma, Managing Director and CEO of Capri Global, joins us. And before I go to him, I mean, what a delight it's been tracking his company over the years now. From a rough patch couple of years ago to shining bright, sponsoring of cricket teams, to incubating the NBFC in the gold business. So nice to see where it was versus where it is and where it will go, Rajesh ji. I mean, quarterly numbers तो चलता रहेगा, but last 3-4-5 साल, congratulations, कमाल की trajectory है.
Thank you. As you rightly said, this is the Amrit Kal of Bharat, and we are part of that story.
Your shareholders, I'm sure, are feeling the Amrit Kal. Stocks gone from 2-digit to 3-digit, now 4-digit.
Yes. I think we are able to benefit from all the structural changes in the rural demand. And last 2 years, we are able to show the growth of 50%. And despite we kept investing in the branch network, now our branch network have crossed 1,000 branches, alone in 920 branches in CGCL and about 180 plus branches in housing finance. So we have built a good branch network, and back of that, there's a good growth happening, and we are quite bullish on Indian economy, where our collection efficiency, where the demand of the loan, where the repayments are happening. We are quite excited about the space we are in.
Growing in rural market when others are not growing?
I would say if you look at the MSME, affordable housing, gold loan market, all these markets are showing a growth. And if you talk about MSME, is still in the segment, the informal segment we operate in, is still there's a huge opportunity gap exists to service those customers like a roadside dhaba, be it a bike repairing shop, be a guy who's selling sandwich samosa, be a tailoring shop. These are the customers who are growing their businesses, wanting to expand, rather depending on the money lender, coming to the organized player of many NBFCs like us. I think that is where the growth is coming in. And overall, if you see the pie of the cake is increasing in their way, we are able to grow our business. Even the repeat loans are happening at a larger size than we used to give earlier. So one is the demand of the volume, the loan is increasing, and number of the people are coming forward. And despite if you see the people who are willing to offer the collateral, there a lot of unserviced market is there where they are not able to get the funding. So we think in next 4 to 5 years, in this era, we should be able to do a growth of 30-35% for next 5 years.
Okay, fair enough. And what about disbursement growth, especially in housing and gold loans? Gold loans has been contributing a lot to your overall momentum. Can you tell us a little bit more in terms of what kind of growth you're looking at here?
So in last 1 year, we added about close to 330 gold loan branches, and gold loan branches disbursal have grown 100% up. So close to 2,390 crore is the AUM in the gold loan, including the co-lending. And we believe that by next year end, we should be able to cross 5,000 crore rupees. So we are on that path. And fortunately, we are getting a lot of bank line under the co-lending scheme. We currently have more than 2,500 crore co-lending line where we are able to even service to the customer at lower rate of interest by maintaining our margin, where we have to just put 20% of us and 80% bank is willing to fund. So there is a high ROE is going to give us. So this year, gold we have in the investment phase have incurred a loss of about 100 crore rupees. By the March, we hope all branches to start contributing in next year. We hope to this give an impact of 150 crore rupees up. So the loss will go away and about 50 crore rupees of contribution gold loan will give. So next year you will see there's a huge upside in the profitability will be seen. The cost income ratio will come down. So unless we start opening another round of expansion, next year you will see that there'll be a lot of upside happening.
You have rolled out the gold product. When you're rolling out the product, there is an initial expenditure. Kharcha hota hai ji initially.
Yes.
Is that over now?
So kharcha is over now. More than that, आपकी gold loan की branch में, if you go in detail, about 30 lakh rupees per branch you have to spend on overheads. Unless you don't reach a AU of 3 crore rupees per branch, you are not able to recover. Till you reach 3 crore, you keep investing and incurring the loss, operating losses. So by this March, we should be able to cross all the branches above 3 crore rupees. And then the contribution will start adding to the bottom line. There, that is how it is. As far as the capex is concerned, is about 14 lakh rupees spent per branch, which we write off over a period of next 4 years. So, which includes the strong room, the furnishing, the security system, and all that. But the major is the overhead expenses till you break even. So I think this by March we should be able to cross all the branches above 3 crore rupees, and where they will start contributing. Next year, if you make 5 crore rupees per branch, there's 2 crore rupees additional. So every branch will start contributing. That is where we are quite bullish about it.
Rajesh ji, home loan book is always a very stable book.
Yes.
It's always like backed by collateral. I want to specifically talk about the MSME book. Now the big picture is that MSME and SME are losing market share to organized player. Big companies are getting bigger. They are struggling because of scale, size and reach. If your loan book is exposed about 30% to MSME and SME, a category which in a sense is getting crunched because of the nature of the economy, is it a good idea to have that kind of an exposure?
So there are two things. One, is there any risk of the delinquency? Answer is no, the book is doing well. But as you said, there's a competition, so there's a margin pressure is coming. So what we have to do, we have to reinvent that. We have to go to smaller location. We have to work rather than the 5 people branch. We have to work as smaller branches where the rents are lower, people are lower, and 60, 70 kilometers that rural area cover. Still, that is a market where you see some of the, say they call it micro lab, and they are able to lend it 20 to 24%. So we have to mix that segment, and some of the competition in South, if you see like 5-star and other, they are able to do high ROE because their ticket size is lower and they completely servicing the rural market. So we also have to do that mix where we are also going to the semi-rural, to the rural branches where of course the volumes are lesser, so that you have to do a very light operating model, but your yields are up. And that is there where organized players is not reaching. So we have to keep reinventing based on the competition. And once we have the customer of gold loan, MSME loan, home loan, that is where we will do the cross-selling. And we are already building our technology. Oracle is our technology partner. LOS is onboarded. LOS completely we are in-house building, and our technology piece is going to give an edge over others. In next quarter, when we completely roll out the technology solution, we will give you a detailed about it, how we have about 100 people team there. So we are quite bullish that our operating cost and our processes will be quite better in terms of cross-selling and reducing our cost. That is where we have to make a difference. Competition will always be there in this segment.
Appreciate your time. Thank you for joining us. Adisa, cricket team mein I forgot to ask you. India to lost?
So I think billions of people got disappointed, but that is what the sports is. The sports can always throw the surprises, so one should not take anything for granted. But anyway, T20 World Cup is coming up in the June in the United States, and let us hope that we make our team give us delightful joy of winning that cup again.
Let's hope so. Thank you very much. Good to have you. What do we have on markets? Nothing actually. PFC is down, REC is down, par for course 1-2% here or there. Reliance is down, it's okay. HAL is holding up, and you got ACC and Ambuja. They both are doing rather okay for itself. So markets holding on, and there is little follow-up buying, but there is definitely no element of any large selling, so to speak, in terms of where the market is.
Okay, that being said, yes, indeed, it is a pretty flattish market at hand. Within the broader universe, yes, you have slight momentum coming in. So check in for some of the names there that are holding out in the green. Tata Investment Corp, nearly in 8.7% move. There's Bama Lorry that's in the green, 5.5% thereabouts. And ITI as well, that's holding out by about 8% or so. CESC, BEML, and Z Entertainment, that stock is active in trade. Let's move right on then and discuss more earnings. RR Cable, it's been a bit of a weakish quarter. We've got Rajesh Jain, the CFO of the company, joining in to discuss the quarter gone by. Thanks much for taking time out. So overall, your Q3 numbers have been a little bit weak, at least when we're looking at the analyst estimates. Margins as well have dipped below the 7% mark. What's the outlook when it comes to your overall earnings as to what were the big drags and what your margin outlook is?
Yeah, good morning, and thanks for inviting us for this call. And if we see our growth, when we see only on quarterly basis, it seems low, but overall, we have achieved volume growth of 20% in wire and cable, which is higher than industry average when we compare 9 month on 9 month. And even in this quarter, we have grown by, in volume terms, we have grown by 10%, and which is on higher base of Q3 of previous year. So still we think we will be able to maintain our volume growth of 20% in wire cable, which is always higher than industry growth.
Margins down for the quarter gone by. I mean, they're down by 1%, but on 8%, if this is a 1% plus drop, it's actually more than 10%.
Yes, again, when we see our yearly estimates where we have predicted that our margins will improve by 140 bits in wire and cable business, and we are on that track only. There are some impact due to product mix in this quarter, but in longer horizon or even on a yearly basis, we'll be able to maintain our growth or margins will be in the range of 8%.
Okay. Global metal
Here
price.
again, very interesting to see. Here again, we have to see that even in FMEG, because we have both the business, FMEG is also contributing more than 10% in our revenue. And there also we are able to have the growth of 20% on YOY basis, which is a very healthy growth. And in terms of volumes, in terms of margins, we are on track.
Peers had recently stated that, the Red Sea disruptions of late have started increasing the cost and even delivery time. With your company having almost 26% of revenues coming in from exports, tell me how these issues have impacted your exports and what are the challenges that you're currently facing?
So this is global crisis, and definitely this will have impact on any business. But since our pricing are very transparent and we have freight is always variable cost and we pass on to our customer, so this will not have any impact on our margins. And good part, in spite of this blockage, also we are having the strongest export growth in our wire and cable business. So we will be able to have good growth even in spite of this Red Sea crisis.
Where is the growth coming from? Is it at the B2B level in terms of high tensile wires? Is it coming at the household level? Where is the growth coming from?
So in export, our majority of the export business is distribution-led business, and it is coming from all geography. And earlier in our business, wire share was more, but in recent past, in last 2 3 years, we were able to have higher growth in our cable business, cable exports also. So growth is coming from both the segments, but more from cable segment in exports. In domestic, if we see our majority of revenue, almost 70% of revenue in wire cable comes from wire only. So whatever growth we have achieved, it is equally from wire and cable, but slightly more in terms of cable growth we are achieving.
What about your FMEG segment? I believe the revenue saw 20% year-on-year growth. In the next 2 to 3 years, you think there is immense scalable potential in this particular segment of your business?
Sure. This industry it is going through a tough phase, and still it is growing less than 10%. But in this scenario also, we are growing at 20%, and in going forward also, by introducing new product in our FMEG segment, we are quite confident to achieve the growth more than 20% or maybe in the range of 25%.
Could you broadly tell us your market share in the domestic market? Because when I speak to some of your peers, they are also confident, they are also expanding, they also are getting business from domestic market. What is your market share?
So it's 7% overall in domestic market, and in that also majority of the sales our comes from wire only. And if you see in last 23 years, we are the youngest company in wire and cable industry, and in this very short span of 23 years already we have gained the market share of more than 7%. So growth is coming, and our figure itself says ki we are the fastest growing wire and cable company in terms of volume. If you see even previous last 3 years or last 20 years also. So we are expecting to grow more than 20% even in near future also.
Including domestic and exports. What could be the split of export? What could be the split of domestic?
So as of now, our exports is 27% of revenue, and it will be in the range of 27 or 25 to 30%, because we have equal focus on growing our export market as well as domestic market also. So we will grow in both the segments, and export the growth may be some bit higher, and this ratio can go up to 30%.
Top markets you export to?
So we are exporting to more than 67 countries, but the majority of our exports is coming from Europe, where UK, Austria, Germany, these are the major countries. Then we have also good volume of exports in UAE and Australia, New Zealand, and the USA also. What we developed in last 3 years, it is contributing almost 10% of our export revenues.
You don't see any problem coming from Europe or from US, given that their local governments are also trying to become more Atmanirbhar, just like India is restricting imports. There also the same narrative has started.
No, but in India, still we have very good opportunity in European markets. Though people talk about slowdown in Europe, but we have not seen any impact. My majority of the export is coming from Europe, and in last 3 years also we have done very good growth. And even the forward orders, whatever orders we have in our hand, it seems this growth will continue. And not only in short term, but we think this wire and cable industry will keep growing at least for next 8 to 10 years, because infrastructure is coming in big way, not only in India but in worldwide also. There is like EV is the very big field, then solar cable or alternate energy is again a very big field. So we are expecting good growth to come from all the segments.
Okay, thank you for taking time out. Expect growth to come in from all segments. Overall volume growth as well has been healthy, and margins around 8%. That's the word from the management of RR Cable. All right, and as we move on, ET Now and ET Now Swadesh, in line with helping Indians rise with India, have partnered with Sundaram Mutual to launch Nivesh Day. This is a groundbreaking campaign that will help viewers build their personal finance portfolios through regular and disciplined investing. Nivesh Day is being celebrated on the 5th of every month. So join ET Now and ET Now Swadesh along with Sundaram Mutual to learn how you can build your financial future with an SIP in mutual funds.